Good afternoon. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion, and I'm here with Claudia Sahm from New Century Advisors, former Fed economist and creator of the Sahm Rule. Also with us, Allison Schrager, senior fellow at the Manhattan Institute and author of An Economist Walks into a Brothel. We're here to talk about the Fed. The context here is kind of interesting and very important. You know, the economy remains strong, in some ways stronger than the Fed would have expected 3, 6, 9 months ago. Unemployment has been ticking up, but it remains relatively low. And for better or worse, we're still talking about inflation. Odds are that core PCE was just around 0.1% month on month for November, but the data over the past 3 months have been slightly less than pristine. So given all that, the expectation going into today is that the Fed is going to cut one more time, another 25 basis points to a new range of 4.25 to 4.5. But most of all, we'll be looking towards those revisions in the summary of economic projections and trying to interpret the Fed's language, I think, to try and understand what they're going to do from here on out. So, Claudia Sahm, what on earth is a hawkish cut? And is that what we're going to get today?
I think a hawkish cut was if Jay Powell were to come out today and say, okay, the committee cut today, but don't expect to see it anytime soon again. Now, that would be very, very unfed-like. He's going to try hard not to signal there won't be a cut next in January meeting. I think the more typical way to approach it would just to say the bar has gotten higher. We've had some disappointing inflation data, and go back to that. We want that confidence reaffirmed that we're moving towards 2%. So I think there'll be something maybe of like raising the bar maybe for the next cut, and they want to see more data. They're not in a big hurry. But I think they're going to try hard not to, put this as too hawkish. I mean, the context here is a lot of progress on inflation since the peak and an economy that has held up, not just held up, has excelled, and especially, compared to our peer countries. So like we have a lot of good things going. So I think it'll be interesting to hear him try and tell the story. Like, how is the Fed thinking about what it's done so far? And I think that's where he needs to spend focus. His crystal ball for next year is not a good one. Because there's just so much uncertainty. But yeah, I think that's the idea. You get a cut, but you're not getting any more. That would be the hawkish cut.
Okay, Allison Schrager, what do you think? How is the Fed going to navigate this?
I think pretty much what Claudia said, that they're going to do one more cut and then leave open as much optionality as possible. This Fed does not like to say one thing and do something else. They like to fulfill expectations. So I think this is going to be like, all right, we promised you one more. Here it is. We're not making any promises going forward. Let's see.
Yeah. And because of all that, because of the way the Fed does business, there really isn't very much uncertainty going into today at all. In fact, near unanimous expectations that they are in fact going to do this cut. But to both of your points, things get really hazy going ahead. We've got President-elect Donald Trump coming in. He says he's going to jack up tariffs. He might deport undocumented immigrants and maybe juice the economy through some sort of unfunded tax cuts that is on top of probably extending the Tax Cuts and Jobs Act. What do you do with this if you're a policymaker, Claudia?
I think you hold your breath right now. They don't have enough details, and there's so much talk coming out of the incoming administration, and Congress has got a lot. I mean, there's going to be a lot of wild cards coming out of Congress too. So I think the Fed has to sit back and let the policy process play out in the rest of Washington to some extent, and it does take time to feed through the economy. So the Fed doesn't need to react right away to all of this, but it's going to, basically next year, the Fed's going to be in the audience like the rest of us, right? We spent a lot of time watching the Fed this year. They're not going to be the only game in town when we get around to next year.
For sure. Well, listen, we've got about 10, now 5 seconds till the decision. I'll bring it to you when it hits, and we'll take it from there. So here it is. They do end up cutting by 25 to 4.25 to 4.5. That's your new range. Now, the action is sort of in your expectations. So your median projection now for the year ahead goes to 3.62. I'm sorry, said that wrong. Goes to 3.875 percent. So that's a meaningful move up. You're really taking a lot of easing out of the picture. You also see the expectations for further easing in 2026. Some of that easing is coming out of the outlook. And then, finally, this is the haziest bit of the whole thing, but it is important to understand how the Fed is thinking about this. The long-term dot, the median projection for the long run, moves up from 2.875% to about 3%. Now, that's not terribly surprising. That's what economists sort of thought would happen. It sort of brings the members of the FOMC into line with sort of the private sector and how they're thinking about these sort of hazy theoretical concepts like R star, the neutral rate, where your rates are neither restrictive nor are they helping the economy out. So Claudia, let me come back to you. What do you make of all this? And man, it's a deluge of information. Where does Claudia Sahm find the the signal in the noise here?
I think there's a lot of noise in this summary of economic projections. And that's not the Fed's fault, right? Like, there are all of these policies that are in play, and then regular events in the world, right, that are in play for next year. Like, this really just, this is them guessing, right? It's an educated guess, and they're thinking through this. But I don't take too much out of this. I do sit and try and think through, like, the longer run Fed funds projection, so the R star, the neutral rate. And what has frustrated me with this Fed is I don't feel like I've gotten a good explanation from Powell as to why that median officials projection has been rising, because we haven't seen any adjustments on potential output, which would be one way that you could get to kind of a higher R star. And the Fed at least has not staked any claim to we have a dramatically different fiscal picture in place, which might be another way that you get to a higher R star. So this thing has been drifting up, but it is frustrating when the Fed conforms to what markets are thinking or what the outside dialogue is without telling us the story, because there's a lot of ways you could get there. And I don't want them to just be doing what everybody else thinks is higher. And it could be, I do think probably the rate, the Fed funds rate that it takes to be restrictive right now, not in the long run, but like right now, it could easily be higher than it had been in the past. Because, growth has been higher, productivity is higher, labor supply, but they haven't staked a claim to like, oh, that's going to continue. So there's this has really muddied, I think, the water some, and yet these aren't huge increases, and like, it's not worth getting too concerned about. And I think the other thing that makes this up a little harder this time to interpret is we're not going to be as certain what each member was conditioning on, right? Like, did they think about Trump's tariffs? Did they not think about those? Right. Like, and that, especially when you look at the line of how much tightening they think is likely next year. This is a pretty hawkish path for next year.
Yeah, sure. Let me just take folks through a few more headlines here, and then we'll head over to Allison. So, one important thing to underscore: the Fed lowers overnight reverse repo rate to 4.25% from 4.55%. There was a technical adjustment that goes on here that had been expected. It was sort of teased in the last minute. Just pointing that out for our money market nerds on the line here. Beyond that, I've got some Bloomberg headlines crossing Fed to assess data regarding the extent and timing of future moves. I'll try and pull that up from the statement and give it to you in context shortly. But we have a note from Fed reporter Katerina Saraiva. The forecast for next year more hawkish than expected. The median estimate, so it now just implies 2 cuts for next year, right? So I mean, you can game that out in a million ways. Maybe they're front loaded, maybe they're back loaded, maybe you get one in June and one in December. But compared to where we are, 2 cuts is not a lot. Also, a bit of a surprise. We get a dissent from Cleveland Fed President Beth Hammack. She's new. She comes via Goldman Sachs. It's a big move for somebody who's just joining the committee there. Allison Schrager, let me jump over to you. Anything jump out at you from this deluge of data and new language?
Well, no, I feel like they're just trying to be very careful. This is a Fed that really just wants to please markets and follow through on what it's doing. Like, as Claudia says, they're not coming out with, this is why we expect our star to be higher, although it's not even really that much higher. It's like a little nod to being higher because, it's a real R star of 100 basis points, which isn't really that much higher than it used to be. It's especially if we're expecting I'm assuming that is going with a 2% inflation that they think they're going to get back to someday. But if inflation is slightly higher, maybe in the 2.5%, it's really not an R star that's that much higher than it was pre-pandemic. So they're like, we have a little nod. Maybe it's a couple basis points higher than it used to be, but it's not really higher for longer. But we have a little nod to some people think it would be. So I think this is just the problem with this whole philosophy that we have to be super transparent. Anyway, we have absolutely no idea what the future holds. So we're going to map out what we're going to do. We're going to tell you where it's going to go, but we really don't know anything. So we're just going to sort of send out a couple signals that reflect what the markets think.
Yeah, and one of the tricky things about reading the tea leaves in that SEP, the Summary of Economic Projections, is it is ultimately a median. It's not it's not this grand plan. But let me point out a few remarks from people at the sort of the extremes of the distribution. At least I think they're at the extremes of the distribution. So Cleveland Fed's Beth Hammack from December 6th. She said in prepared remarks, we may not be too far from a neutral setting today. She thinks we might already be very close to that neutral setting. Fed Governor Michelle Bowman on November 20th, we may be closer to a neutral policy stance than we currently think. Dallas Fed's Lori Logan on the 13th. I see substantial signs that the neutral rate has increased in recent years and some hints that it could be very close to where the Fed funds rate is right now. Allison, what do you think when you hear those? You agree? Like, what does that tell you about where we're going here?
I mean, there's reason to think that, and that, rates do not seem to be slowing down the economy much. Now, I mean, I think there's a concern that to some degree we're seeing signs that the rates aren't having a big effect on the economy because people are doing things that suggest they're expecting rates to fall in the future. Yeah. For instance, things are going on in the private credit market. I know people who are taking out mortgages anticipating they're going to refinance in 5 years when rates go back down. So that might be, why rates maybe, and even high rates here, feel neutral. Maybe they're not. Or it could just be that, the economy is less sensitive to rates. I mean, it could be a lot of things, or we could be in a higher for longer world. But I think Claudia's right. I can see why they're not explaining why they think higher for longer is the new normal, or R star might be higher, because that also requires them to really sort of get into political issues that they definitely don't want to get into, particularly with Trump being a little bit more punitive about his appointments. So that might be why, but it is just sort of, it doesn't really offer, I think, the guidance that all the sort of forward guidance and expectation management monetary policy is promises to fulfill.
Yeah, sure. Let me just real quickly take folks through the actual language in the Fed's statement. We are going to sort of unpack the nuance a little bit more at the Jerome Powell press conference, which is going to hit at 2:30. But for now, this is sort of what we've got. We see. We see no changes in the statement in the first two paragraphs, right? So I'll just skip over those. But when we get to the third paragraph, it now says, in support of its goals, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4.25 to 4.5, in considering the extent and timing of additional adjustments to the target range for the federal funds rate. The committee will carefully assess incoming data and the evolving outlook and the balance of risks. So I just want to point this out. You can actually see this on the screen. I know it's hard for some folks to see on the screen share, but it's in that second sentence. It had previously said, in considering additional adjustments to the target range for the Fed funds rate, but now it says, in considering the extent and timing of additional adjustments to the target range for the Fed funds rate. So we're adding more conditionality, and if you're the sort of person who reads the tea leaves, I don't know, maybe you get a little bit excited about that. Do you get excited about that wording change, Claudia Sahm?
I mean, it opens up the amount of time that was spent on this word crafting. Is probably amazing. But I'm a little concerned. As Allison said, they are trying to open up all optionality. And they're trying to do it to the committee too, because it's clear. I mean, if Hammack feels strongly enough to dissent, even on the committee, they've got some people that are uncomfortable about where rates, where they're at with the path. So this is a nod, because extent implies, well, maybe there is no more, right? Like the extent. Whereas, Powell in the summer, when his whole direction of travel is clear, well, this is in very turgid language, kind of backing off of that nice, sweeping statement, because it isn't saying that. It's saying we're going to have to see what we do at all. Now, I think, there's nothing in here that is putting in place we think inflation is picking back up, we're going to have to, raise rates, which has been some reaction to recent inflation data. But this is a much more cautious. But I will remind everyone, this has been the tricky part of this rebalancing. The disinflation period has gone on for over 2 years. The Fed waited until September, after much progress on inflation, to say we feel comfortable, we're in this direction. This has been an uneven path, and we are almost certainly that is in store coming into next year too, right? We are bumping around, trying to get inflation down, and we could see this narrative about inflation and the unemployment rate could turn pretty fast with not much data, because we've seen that already. It's just but it's fine for them to have put the options out and be maybe a little more humble about where the data are leading.
Yeah. Well, on top of all of that, let me actually put a screen share up real quick of the market action, so that so that folks can follow along. I wanted to put up the yield on the 10-year Treasury note, because Allison, I want to ask you, sort of, if you were to proceed with cuts, kind of, in a sense, I feel like we want to ask ourselves, kind of, what would be the point? Because financial conditions have been doing some interesting and sort of divergent things recently. On the one hand, we've got the stock market, which is kind of on fire. We've got credit spreads, which are pretty narrow, but the parts of financial conditions that have been tight sort of remain tight. And that's the longer end of the Treasury curve. That is 30-year mortgage rates. And in fact, since the Fed started its cutting back in September, you've seen the yield on the 10-year Treasury note move up about 75 basis points. In fact, that was before today, and the intraday chart that I have up on my screen shows it moving even higher still. Right, we're up about 5 basis points just on the day. So, my question to you is the long end of the curve getting away from the Fed? And B, corollary to that, like, if you were in the camp that you think we keep cutting, what do you think you're accomplishing with that?
Well, there's a lot to unpack there. I mean, is the 10-year getting away from the Fed? Did they ever really have it? I mean, it looked like it did when the yield curve was quite low and fairly flat. But traditionally, we always thought of the longer end of the curve, anything beyond 5 years, as being segmented from monetary policy. The monetary policy has a lot of control over short-term rates, but not over long-term rates, which are driven more by long-term macro factors like expected inflation, inflation risk around the bond market, risk around the treasury market. So, I mean, there's a lot going on. I think it doesn't reflect to me poorly on the Fed of what's going on in the 10-year, because, there's all the uncertainty we've been talking about should be showing up in the 10-year. But to what extent does cutting achieve anything? I think it does achieve something. I don't think it necessarily achieves anything in terms of markets directly. I don't think this cut's going to cause any harm. I don't think it's going to have much benefit, but it does give the Fed ammunition to say, hey, inflation went up. We got it back to normal. And we normalized rates. And then, hey, tariffs came along and, what could we do? Or treasury went up and, inflation came back, but that wasn't our fault. We have credibility. We can do something about it. So I think the cut kind of can justify that story for them.
Okay. All right. Fair enough. Claudia, are you worried at all that this committee is gonna be a little bit paralyzed next year, perhaps by disagreement, by inflating? I mean, we saw the dissent today, and we know how hard the decision making is just going to be just based on the policy and macroeconomic backdrop next year. And then if you sort of look at the distribution of who's coming in and who's going out as voters next year, our team here at Bloomberg Economics, their sort of assessment is you have more people at the extremes, right? You do have a perceived dove coming in as in Goolsbee. You have a couple of hawks coming in. It just feels like the distribution is going to be more bifurcated, and I wonder, what that means for us. The American people, consumers of the Fed's monetary policy. Is there a risk that they become sort of frozen in place because they can't do the consensus building that's so important to make a decision?
I would worry more about the policy uncertainty next year, really slowing them down. If the tariffs come to pass, it's even, the Fed, if you have a targeted set of tariffs and there's not a large retaliation and trade war, the Fed should look through those price increases. They're temporary. I mean, if you look at the SEP, somebody didn't listen to Jay and put tariffs in there. I mean, you do see these kind of bumps into, or at least that's what it looks like to me. These temporary increases in prices. But do you really think this Fed is going to cut when we have inflation picking up, even if we can pretty confidently say because of tariffs? I mean, they did cut when the first tariffs went under Trump. They did the Powell Fed did cut, but it was in response to a growth scare at the time. So again, next year is going to be really tricky. I don't think there's assumption of the path of inflation could be a lot of different things next year, and we could see as many different reactions from the Fed. So I think they're just going to have to, they're right in this is a very unusual set of circumstances. Now, for as much as there are hawks and doves on the Federal Open Market Committee, this is a group that is very collegial, that works hard together, has a lot of respect for the different voices. And Powell has proved himself very adept at bringing, building the consensus, getting them to a decision. I mean, it took a while for the first cut this year, but they did get there. So I'm not worried about them getting stuck in place. I'm not worried about them getting afraid of being in the crosshairs of the politics. I just think they're going to have a lot of policies and developments coming at them that are tricky, and we've all been head faked more than once now on both inflation and unemployment. So I think that could slow them down because they want to be more sure.
Yeah, and it might have some benefits. I mean, if you recall all those Torsten Slok pictures of when the Fed was in lockstep of this is where we're going and this is what we're going to do, and then they didn't do any of it because the data kept surprising them. So at least if they have a wider range of views, they seem less wrong because, someone saw it coming. Yep. So I guess it sort of nods the uncertainty. And, a couple of economists I know have pointed out that maybe, as Claudia points out, if there aren't retaliatory tariffs, we might not have sustained inflation. We might just have an increase in the price level. And then all these economists who run around screaming tariffs are bad because they increase inflation. And tariffs are still bad, but inflation didn't go up. We lose a lot of credibility. So, sometimes it's good to have a little bit more uncertainty and a little bit less authority because, you risk also just being completely wrong later.
Right. Yeah. One thing I wanted to just underscore is these policymakers, they're well aware of the uncertainty. They're not out there saying they have a crystal ball. In fact, if you go to, I believe it's page 12 of the PDF, they break down the risks and uncertainty around their projections. I'll just give you, for instance, risk to core PCE inflation, so important, core PCE inflation projection. And you see a lot of participants on the FOMC saying that their perceived risks to PCE inflation have moved up. And now they're not saying that that's because of Trump and tariffs. And if Jay Powell is asked about Trump and tariffs at the press conference today, I imagine that he is going to avoid that like the plague. But I think the fact that you do see uncertainty, rankings of uncertainty being ratcheted up, rankings of the risks, the upside risks to core PCE moving up so dramatically from the September projections. I think that that's really telling you that a lot of these policymakers are exactly where you two are, which is to say, gosh, it's a mighty foggy road out there, and we better just slow our roll and be careful out there. Is that right? And am I putting all of this together in the right way, Allison? If you were sitting in that seat, would you basically just pause here and look around, maybe for a few months, maybe even a few quarters?
Yeah, I mean, I think you're exactly right. I mean, as Jason Furman keeps pointing out, a couple months of data doesn't necessarily make a trend. So we don't know if we've just stalled out and 2.5-3% inflation is where we live now, or if this is just sort of some, a blip and we're going to continue falling, or maybe we're going to go up. We really honestly have no idea, and they don't know either. So the best thing they can do, as I said, get as much optionality as possible and, see how things go.
Yeah. And Claudia, one further point, I wanted to come back to something that you said on tariffs, because it is very interesting. And we do have a precedent, right? Trump waged a trade war during his first presidency. The Fed ended up cutting in that context. So it's a little bit counter narrative. But it's also the case that the macroeconomic backdrop was so different back then. Don't you think so? Doesn't it feel like maybe there's a reason to manage this situation differently, given that we're coming off the back of this sort of jarring inflation experience?
Well, the only thing I would say is, keep in context the PCE core inflation or PCE inflation, right? So let's take the target. What we'll likely get is the print coming soon. We know that we've had the CPI and the PPI. It looked better in PCE probably. It should print at about 2.5%. Okay, 2.5% is not that far from the target. Now, we had a different problem, and I think actually this very much is context that supports this, this time could be different. And we got to remember, for years before the pandemic, we had inflation that was not up to 2. And like the Fed really saw this as a problem, and it was because they weren't getting their job done. It was a sign of an economy that had a lot of weakness to it. So yeah, we instead of being in a low inflation environment where I think the Fed could say, hey, inflation comes up, that's fine. We're going to cut anyways. We could use some, they needed some extra help on inflation as it was. So it's probably not a big deal. This time we're in a case where it's all about maintaining and getting that inflation down to 2% and not getting stuck. So yeah, this cycle in so many ways just hasn't had a precedent. And I mean, context is always important for macroeconomic policy. So no, I'm not suggesting anyway that I think my money would be on the Fed cutting if there were tariffs. But, we have seen this as a Fed that's willing to go to bat for the labor market.
Right.
I mean, I know we're going to print probably another really nice GDP growth for the fourth quarter, but there'll be a growth scare at some point next year. It may just be a scare, right? It may not be a softening. And the Fed's markets forecasts have the growth slowing pretty notably next year because this has been unusual. Like, why is growth so strong? And so I think the context makes a difference. But as I said, but I do think the Powell Fed has been more tuned to some of the labor market issues than one like kind of standard issue Fed might have been.
Okay. Well, listen, our commitment always is to get our panelists and our viewers off in time to see the Powell presser. But before we let you go, let's go around the horn real quick. Allison, what are you still looking to learn from Jay Powell in the next 30 minutes, or in the next couple of hours, I should say?
I mean, I'm curious what he thinks about what next year is going to bring and sort of glean any expectations he has about the macroeconomy, about inflation, about the labor market, if, what his expectations are.
Okay. Claudia, what about you? Any specifics that you're looking out for?
I want to hear him reinforce the story of the percentage point of cuts the Fed has done this year. Right, like kind of tell us, because I don't think it's a mistake that the cuts have been made, and I think there's a lot behind it. But to him to continue to tell this story, and we need to hear it from him. We can read whatever we want to into those dots. We really need to get some guidance from the chair.
All right. Well, here's the deal, folks. The yield on your 10-year Treasury note off the back of this decision is up about 5 basis points to 4.44, 4.45%. The Fed has cut by 25 basis points, but it's gone ahead and moved up some of the expectations embedded in that summary of economic projections. So we're going to let you go so that everybody can read the tea leaves from this very important press conference. Thank you so much for joining us. Thank you to Claudia Sahm. Thank you to Allison Schrager, and we'll see you in 2025 for some more of these.
Thank you.